What's good, people? What's good? Welcome back. And this is just basically a follow-up video from my last video. And in my last video, we basically talked about, what's the best time to buy the major ETFs. And, we talked about the 5, 10, 15, 20% rule of investing our money into the market, especially into those major ETFs, especially if you're a beginner and you want to start generating nice returns or market breaking returns, while you continue to learn. So let's say, for example, you're investing into the major ETFs at, if it's down 5, 10, 15%. And at the same time, you're studying the bear markets, right? And when you're studying bear markets, I don't know if I talked about it in my last video, but I did say that bear markets are like the best opportunities to buy stocks. And I did talk about how we've been spoiled for the last few years, that, bear markets usually, last longer than a few months. We've been blessed that these bear markets that we've been given have only lasted a few months. But there are bear markets in the history of the stock market that it took us years and years to recover. And that's something, if you're a beginner, you should be studying, and how that affected individual stocks and how that affected the major indices, right? So now we're going to be talking more about how to understand when an individual company like Apple, like Microsoft, Meta, when these stocks are buy. Of course, remember, these are my assumptions, right? These are the assumptions I made with the research I've done on these companies to come up with what I would pay for the company, right? Because as when you're an investor, you have to remember you are technically looking at the company to buy the whole thing. And I wish when I started my journey, I felt I came across a video like this, because I didn't think about the stock market in that way, right? And that was my fault, because I was trying to make money, because I watched a YouTube video, seeing a dude day trading making money. But really, that's not realistic, right? It's not realistic. The best way to make money in the stock market, and the easiest way to make money in the stock market, is to understand the business and buy for the long term. So one of the first tools, right, that I wish I knew when I was starting off is basically this website. And I'll have all these websites in there for you guys that will help you, research, your own companies. Let me just go back to the homepage. Let's say first, so this is the sec.gov website, right? And this website has a bunch of cool tools and stuff like that, so you can play around with it. But what I really use it for, well, I don't really use this, but it's a really good website to know. So if you want to use it in the future, is you could basically look up any company, right? Let's say, for example, we're gonna look up any publicly traded company. Let's say, for example, okay, Nvidia. We're gonna do Nvidia, and you could basically look up the 10Ks and their 10Qs and other filings too, like a bunch of stuff you can look up for the company that they have to file these things, right? And they have a period of time that they have to file these things, right? So what is a 10K, right? The 10K is exactly what it says up here. It's an annual report, and is extremely important, right? In my opinion, you cannot consider yourself an investor, and you should not be investing, right, if you don't know what a 10K is, if you don't know what a 10Q is, right? If you've never read a 10K, right, just stick to ETFs, right? Don't buy individual companies, because, well, you really could do whatever you want with your money, but how can you, call yourself an investor if you never read a 10K, right? And I was investing never knowing what a 10K was, right? And a 10K is just basically a description of what the company did that year, right? So there's a 10K for every year, right? Every year. And then you have your quarterly your 10 Qs that basically gives you what the company did in those 3 months. The 10K is extremely detailed, right? Extremely detailed. It tells you what they're doing with the money. It'll tell you the risk, the competition. It'll describe to you the business. It's extremely important for you to read the 10K. It is a super long document, right? It's super, super, super long, right? It's super long because it's a description of everything the company does, like what it's doing with its money, how it makes. It's like the numbers. It's the pure numbers. And on this channel, I've said it all the time. I live and die by the numbers. I don't care about the dream. I live and die by the numbers, right? And it's really cool to read these documents. So if you're an investor, right, use this website, right? I don't use it too much, because you could do the same thing if you did this. Let's say, for example, a stock that I was researching today, this one, right? So basically, you go every publicly traded company, and maybe even some, I doubt it, some private companies, but I don't know. I don't really look into private companies, because I'm not rich enough to invest in them. So every publicly traded company has their own investor relationship website, right? And this website is really good. You could do the same thing. You could go here to sec filings, and let's say, for example, if you want to look at the 10Ks or whatever your annual filings, boom, you get all of them right here. And you can continue looking and stuff like that. Pretty cool. So I usually go in here because usually when I'm doing that too, I'm looking at the press releases, right? And usually I'm looking at the press releases when I'm looking at the quarterly numbers, right? When I'm looking at that 10Q, because the 10Q is going to give you a good description, but it's not going to be too detailed like a 10K. But the press release was basically, but be careful with the press release when you're looking at those earning statements, because the press release are kind of a little biased, right? They could be, they could be, not that they're going to inflate the numbers, but they're going to be biased, right? They're going to make the company sound really good, right? And like I said, we don't care about the story. We care more about the numbers, right? So we're just looking at those press releases for the numbers. So you should be reading the press releases. You should be reading that in conjunction with the earnings and that 10Q, and you should be listening to the earnings call. It's super important for you to you have to be listening. So let's say, for example, you buy Microsoft, right? You should, every 3 months, right? If you want to be deep in the game like that, you need to be listening to the earning calls, because you need to understand because sometimes the market go, act crazy. Like the market might not like one thing that the CEO, whoever says something apart in the business, and the stock could drop. But maybe you understand that, the company might say, for example, we are going to invest very heavily for the next few years, and the stock might drop because investors might not agree with what they're doing with their money. Investors believe maybe they should be doing more buybacks and stuff like that. Maybe the investors just don't agree, so they sell the stock, right? And now the stock is dropping, and you being a long-term investor, you'll be like, well, if they're saying the company's going to be stronger 5-10 years from now, why would I sell? I'm in this for the long term, right? So that's something super important, that you should be listening to those earning calls, right? So you can understand why the market swayed, right? And you have to remember too, don't pay too much attention of, let's say, for example, you're listening to an earnings call and the numbers, you looked at the press release and the numbers look incredible, but the stock might still drop. And I think we talked about that in some of my videos. And you have to remember, the stock market doesn't really care about what, okay, hey, round of applause. You did great this quarter, but they care about what's going to happen next quarter and next quarter and next quarter. When a company is more, you could see farther out, the market is willing to give them more credit and give them a higher premium. And we'll talk about that, in a little bit when we talk about evaluating individual companies, right? So that's one website you could use, or you could use the investor relationship of the individual company that you're researching, right? And remember this, when you're researching, you're not glimpsing over stuff. You're coming up with a theory and why you believe the price is where it's at, and I'll explain to you why you're doing that. All right, so another cool website that you could use, right? And I really love this website, is Investing Pro, right? Reason I like this website is because of it has a bunch of cool little things to teach you, and it has a bunch of information, right? A lot of times I'm using it for the earnings, right? And I'll talk to you why I like this for the earnings. So you get to see the projections, you get to see the amount of analysts that are that made their assumptions. You get to see the high end of the guide of their expectation, the low end. You get to see the forward PE, right? You get to see the forward PE of what you're paying right now for the company. For example, so if you was buying this company right now, you're paying 35 times earnings, and I'll talk to you about a little bit about that later. But you get to see how that works for the stock, right? For the individual company, you can look at the finances, you look at the models, and we're going to talk about models and stuff like that too in a second, right? So this is a really cool website. It's pretty cheap. Look into it. They got a free tier, so you could, I think you could, not a free tier, but they do have a free tier, but you could, at the same thing, you could I think you could try it out for a couple of days without having to pay, right? All right, so now we're gonna come to the most important thing, right? How do we value companies, right? And I want to talk to you about, there's a bunch of ways to value companies, right? You can use technicals to value a company, even though that's not the best way. But in my opinion, if you're starting off, the best way to value a company is, and not all companies you could use this, right? I'm not going to talk about all the other companies that use other methods. I'm only going to talk about companies like a Microsoft, a Meta, stuff like that. And we'll talk about that. We'll talk about that too. All right. So the way we value companies, right? There's a bunch of ways to value companies. You could value companies based off of their PE. And I'm going to see, let me see if I can pull it up. Let's see if this chart has it. Let me see. Overview. Okay. So there's ways, right? There's ways that you go value a company, right? There's valuation ratios, and I'm gonna only talk about 3, but there's a bunch out there. I might talk about a little bit more when I'm evaluating, but there's 3 major ones that you should understand, right? You need to understand what PEs, right? PE, right? Price to earnings, right? You need to understand what price to sales and price to book, right? Because these ratios will tell you the market expectations, right? Like for example, using this one, right? We're gonna say this 43, right? A 43 PE, right? That is a premium, right? That is a premium, and you need to ask yourself when you see something like this, right? What is the forward PE? Because this is the trailing PE. This is the trailing 12. This is the current PE right now, right? This is what you're paying for the company now. However, when we're valuing companies, we're not valuing companies on what they are today. We are always valuing companies on what they are going to be 5 to 10 years from now, right? What we care about is the future prospect of the company, right? So I don't really care too much about the current PE. I care about the forward PE. What has been the historical PE over time, right? Does the company usually trade at a 30 PE? So if it usually trades at a 30 PE, why is it trading at a 43 times PE now, right? And that's going to tell me, is the market too optimistic? Is there some type of growth here I'm not understanding, right? That helps you, right? Same thing with your price to sales ratios. Another thing, you want to compare those price to sale ratios, PEs, and price to book with their sector, right? Because you might have, let's say for example, Nvidia. Let's say Nvidia. No, more better. Let's say Tesla, right? Let's say Tesla. Tesla usually has a high PE and it has a high price to sales and has a high price to book, right? And when you compare it to other automakers, right, you might be like, why is there such a drastic difference, right? And the reason why is because Tesla, the market is expecting bigger things from Tesla. They're expecting robo taxis, robot Optimus, all these other things, right? If he with SpaceX included and stuff like that, the market is expecting bigger things. That's why they'll give them a higher premium, right? So like if we pull up Tesla PE, right? And like I said, do your own research, right? Do your own research on what is a good PE, what is a cheap PE. And it really goes based off of, like, there's a book answer and then there's like a by industry answer, right? So like you see here, the other company we looked at, they had a 43 PE, but now you look at Tesla, they have a 377 PE, right? So you're paying a lot for this company, right? And the only way you could justify is you believe that Tesla is going to be a company that's going to be revolutionary, right? You believe that when you look at this company 10, 15, 20 years from now, you believe this company is going to be a juggernaut, and you believe that you're basically putting all your faith into Elon Musk, right? So that's it, right? So that's what those ratios could tell you. Those ratios will tell you what the market expectations are, right? And you need to either agree with them. So when you're purchasing that company, you have to either agree with them or you disagree. It's up to you, right? After you do your research, you read that 10K, you look at those 10K, you read those press releases, you listen to the earning calls, and then you look at these ratios, or you can look at the ratios first, right? So you could try to understand why the market's doing that. And the most important thing is you need to look at what the earnings are, right? You need to look at what the earnings per share are. What is the growth projections, right? Super important, because remember, we don't care what the company is today. We care on what the company is going to be 5, 10 years from now, right? They believe this company is going to be at $900 billion by 2035. How, two analyst expectation, no, but we need to take that with a grain of salt. It's only two. Like, we should definitely give these guys more weight because over 30, 40 people, even these guys right here, you got 9 and 9, but we care more about what the company is gonna be tomorrow. We don't care what the company is today, right? You have companies in the market today valued at $1 trillion company that are not generating any cash, right? So this is where your discounted cash flow comes into play, right? And I'm not gonna go too crazy into discounted cash flow because that's a video in itself. YouTube it, talk to ChatGPT on what a discounted cash flow. But the gist of it is basically if this company is generating, cash, right, and that cash is compounding, right, it's growing, and the way this kind of cash flow works is you're assuming this company is gonna grow forever, right? That's why when sometimes you're looking at a stock, right, you might be looking at a stock, or you could do your research. Look at some stocks like Roku, TD, what is it? I think it's a Trade Destination. I forgot the name, but go look at any company that had a huge drop, and you'll see that the drop happened because either when they did their earnings call, they slashed guidance, right? They slashed guidance. So if they slash guidance now, that's basically saying, hey, we thought we was gonna make this in the future, but now we don't really know. Those are the most dangerous words you could say as a CEO, an individual. The most dangerous word you could hear as an individual investor is a CEO telling his investors, we don't know what the company's gonna do next year. At that point, you can't project. At that point, you can't determine. You can't use a discounted cash flow because a discounted cash flow is basically saying, if this company generated this much at this percentage for the rest of its life, what would this company be valued? And I'll show you what that looks like here with my example, right? So this for me is how I do my research, right? And let me show you the tabs, right? So I have my main tab, and this is where I put all my information: how the company makes money, what's the shares, blah blah blah, a bunch of stuff. The revenue growth, how they make money, how I get to my growth rates. I use my projections. This is what I use. This is how I use, and I put everything in here. Anything I could find of value on that 10K, and I want to track, right? I do my quarterly, and then I go to my valuations, and sometimes I do even like a price history, and I'll talk about that in a second after I talk about the cash flow, right? So boom, you could get a cash flow super easy. You tell ChatGPT, hey, make me a cash flow for whatever, right? And they'll make you a cash flow, make a website of a cash flow, whatever, right? Super important, right? Because the cash flow is basically how, great investors like Warren Buffett uses cash flows. All fundamentals, all great investors use cash flow, and they understand what a discounted cash flow is, right? So for example, right, your cash flow is how much cash the company actually generates from its business, right? How much cash does the business generate? Let's say, for example, with Microsoft, right, they're generating $70 billion of cash, right? There's not many companies in the stock market generating $70 billion in cash, right? Right. So you basically make an assumption. This is pretty much a crazy assumption, but you're basically gonna say for the first 10 years, right? The first 10 years, you're projecting them that they're gonna grow 20% year over year, right? The way you do you gotta do your assumptions however you choose, right? The way I do it is I look at the earnings, I look at the expected earnings, I look at the how they generate usually how income, because net income doesn't always convert into cash, or sometimes it does convert into cash, and that's because of accounting principles, right? And like I said, you'll have to do some research into that because that's a whole different video to talk about, right? But there's ratios that you can look up that will tell you from the net income what percentage of the net income turns into free cash flow, and that's what I use to make my assumptions, right? So if a company has like let's say for example, and I look at the last 10 years, right, and they have like they have an 80% conversion rate of turning that net income into 80% of real cash, that free cash flow, I'm gonna use 80%, right? I'm gonna push my projections out. I'm gonna say, okay, if they're generating $1 trillion in revenue, and their margins stay the same, and they convert, let's say the margin stay at 33%. So their net profit is 33% out of a trillion, and they, convert 80% of that. Sorry if it's a little confusing, but I'm trying not to make the video too long for you guys. But let's say you convert 80% of that, right? And whatever that number is, right? And you're gonna basically project, okay, if we could grow that cash for a 10% forever, for not forever, sorry, for 10 years, right? And then after those 10 years, we're gonna say it grows at 3% forever. Why do we do 10 years? And the reason you would do 10 years is the same reason why you don't have you don't have analysts telling you in 2050 Microsoft is going to generate $2 trillion, because it's harder to project what's going to happen. That's why you see here more analysts over here, because it's easier to determine what a company is going to do in anywhere from 3 to 5 years, and you can make a discounted cash flow for that, right? And I'll talk to you about that when we go back to the discounted cash flow. You can make an assumption like that, right? You can make an assumption. A lot of people just do 10 because it's easier to project 10 years out. So you have to, I got that text message. So it's easier to project 10 years out, right? And then how you really don't know, you would basically use that 3%, saying that it's going to grow that 3% forever until something happens, and you don't know, right? So we're going to assume the company's going to grow at 3% forever, right? So let's go back to that cash flow, right? Go back to that cash flow, right? So that's your terminal growth. The discount rate, right? That's another reason why I like Investing Pro. Investing.com has let me show you. Basically, you could go basically right here, the data, and if I just tap in the WAC, and I use WAC, right? And you should use WAC for some of your evaluation, but for this kind of cash flow, you're gonna use WAC, right? So boom, it's gonna tell you what it is, right? 11.5 for Tesla. However, the WAC is debatable. The WAC is, a lot of people will tell you, is how much you're willing to risk to purchase that asset. I think you should go based off of the fundamentals, right? You should go based off of the calculation, and ask ChatGPT to do the calculation, or you could get Investing Pro and they'll do it for free. So, well, not for free, you're paying for the service, but you could do that. However, a lot of people do their own way for the discounted cash flow, but you need to be careful with the discounted cash flow. That's why I choose to use fundamental data for it, because some people might use like a 7, an 8, and let's say if we change that to a 7, you can see how drastically it changes the price of the stock, right? So you need to be careful what discounted rate you use. I think you should use WAC, but if you feel more confident, for example, if you feel more confident in Microsoft, you could be like, oh, I think it's an 8 because I give companies like Microsoft an 8, and I'm gonna give companies like Microsoft, Apple, Google an 8 because they're just great companies. Whatever floats your boat, whatever you want to do. I use what I use is what I use, right? Oh, terminal grade. What I use is what I use, right? Because I use fundamental. I want like, if somebody else was doing it, I could tell them, well, based off of the calculations, it should be this, not feelings. I don't want to use no feelings when I'm doing an assessment of this stock, right? And then you'll get your valuation, right? And you could divide that by the shares outstanding, and you could get the shares outstanding, right, from the 10K. You just got to read the 10K, and you get the employee count too. And then the net debt is a ratio that you could use that basically subtracts cash from debt. And if it's positive, that means they have more debt than cash. So you could subtract that and add that to the total of the enterprise value, and then you could come up with your scenarios. Let's say, for example, you can have a bear case scenario, basically saying, hey, I believe if margins stay the same for the business and they just continue to grow revenue, they're valued at 400. Base case, hey, if the margins improve slightly, and this is the price, right? And then you have your bullish case scenario, and I'm going to show you how I put them on a chart, right? So let me show you how I put them on a chart, right? So let's say, for example, so usually I do it like this, right? So this is not accurate because I I think I did do a discounted cash flow for Tesla, but I'm not interested in buying Tesla, so I just use it because as an example, right? So let's say, for example, you'll have your three zones, right? And I like to call them your three zones when you use your discounted cash flow, right? And before you actually implement the discounted cash flow with real money, I would say do a lot of studying, right? Do a lot of studying, because I did a lot of case studies of comparing, you know, what a company value was 10 years from now to what it is now, and I track the revenue and stuff like that. So you got to do a lot of case studies if you want to use this, right? But it usually works like this for me. If I say, hey, this is my bear case, and my bear case is basically saying, you know, because usually I'm gonna have a base case. I'm usually very neutral, right? But I always say, okay, what's the worst the stock could be at, right? And basically, my bear case is basically if I like the stock, that's what I'm buying. That's where I'm buying, right? That's where I am buying the company. I feel like this is why I tell myself the price is too good not to pass up, right? So anytime it's in the zone or under the zone, I'm buying, right? I'm buying, right? This is where my base case scenario is where I think the price should be, right? Maybe I won't buy it at fair value because I want to be a great investor. I want to get it under fair value. I want to get it for a steal. And then usually I want to sell in my higher zone. This is where I believe the market is too optimistic, and this is why I think I should be taking profit. This is my theory of how I do my research, and when I'm thinking about a company, this is how I do my research. However, one thing I would say, right, is you have to think, you know, your theory. Let's say, for example, somebody think that buying, you know, somebody might think that this is the bear case and this is the up here is the bull case and here is the fair value, right? And you could see, right, you could see that both theories could be correct, right? Both theories could be correct. Somebody might say, hey, I think this is down here is too good to be true. I think here is fair value. And I think, higher up, is the selling zone. And at that point, it's too good to be true. One thing about the market is multiple opinions could be right? Multiple opinions could be right. So never read somebody else valuation of a company and get fearful and sell, because they might think the company is overvalued. They might think the company is undervalued. Both of them could be right. At one moment, it can be overvalued. At another moment, it could be undervalued, right? So both theories could be correct, right? So this is how, in my opinion, you should be doing your research. This is how you should be doing your research when you're looking into individual companies. You should be coming up with bear case scenarios, or you could be like buy case. I'm good. I think I should sell. However you choose to do it, right? But the most important thing is you have to do a lot of research, right? You have to do a lot of research. And the way I have it for my Excel, the way I do it with Excel, and I like using these, and I do this with a lot of companies. Right? Because I research a lot of companies, right? I research a lot of companies, right? That's all I do right now. I research companies and I read about them so I can understand, and I study them, right? Like with this one with Microsoft. Let me show you this one with Microsoft, right? Sometime I might want to do a price study, right? And with the price study, I'm basically saying, okay, when did the stock like drop? Like for Microsoft, when I was buying Microsoft, right? Because it was dropping, and I'm trying to understand like why. People don't see what I see, but sometimes people don't see what you see, right? Or sometimes they do. The market is kind of crazy, but sometimes you could do a price study, and you could be like, okay, how many times did the stock hit the 200 moving average, on the weekly, right? Like how many times did it hit it on the weekly? Like I'm gonna show you a great example. Let me see if I can pull up a indicator, and I'm gonna not there. Indicators. Let's see a moving average. Let's do 200, right? Let's see 200, and we're gonna delete these, and this is gonna be the last thing I talk to you guys about. All right, let me see how far am I gone on the video, guys. Ooh, 29 minutes. Okay, we're gonna be done with this, right? But let's say, for example, you could say, hey, every time since 2022, when Tesla was under the 200 moving average, that's a buy. So you could, that could be your buy, right? And you could calculate how long it stayed under there and all that good stuff, right? I'm about to cut the video short here, guys, but basically this is how you would do the initial research into, you know, buying a company, right? And there's so much more, right? There's a lot more. You know, you got to research the competitors, you got to research, you know, understand who the CEO is, what the goal is for the company. Like, there's a lot to do, guys. That's why I always say, right, start off with the ETFs, take your time and learn, and I promise you, you guys are gonna do you know, really good. And the most important thing, right, when you come up with your theory, right, of course, never go too big, and you have to be patient. Sometimes, right, it might take a few months, it might take years. Like I talked about it with Adobe, right? Adobe stock has been getting killed, and they're performing pretty well. It has a low PE. It might look like a great buy. It might look like a generation buy. However, you don't know when the market will, you know, prove your theory to be right, right? So you need to be ready to be able to wait for your theory to plan out, right? Patience is the game. Remember that video I made about Warren Buffett, his greatest power was patience, right? Thank you guys for watching the video. Hit me if you need me. You guys have a good one.